New all-time highs keep coming in, but the semiconductor sector is flashing a little bit of a warning. The relative trend score has moved from 10 to 0 quite rapidly, which historically has signaled a slowdown in the S&P 500 over the next 6-month period. However, looking at the average bull market, 6 months is nothing. Bull markets that have made it at least 2 years typically go on for at least twice as long, usually much longer. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan to determine just how concerning that semiconductor statistic is. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, a solid green-bodied bar, definitely a smaller body, smaller range, relative to some of these previous green-bodied bars back here, but regardless, the buyers do a great job of closing strong near the highs of the weekly range. It's bulls on parade. If we're thinking about location on the bar-to-bar count, we certainly see a higher low, as well as a higher high, and a close completely outside of and above the previous week's range. Therefore, the bulls go 2 for 2 on the bar-to-bar count here on the weekly time frame chart. Of course, this is a brand new all-time high close on the weekly time frame chart, and therefore it's the highest high in the trend count. So overall, the uptrend is intact, and although there is no indication of a pullback looking imminent, we know that we can afford a higher low pullback if one were to emerge. And the key line in the sand that I'll continue to use on the weekly time frame chart is at 585. The reason being is that this pullback from back here really did not yield a daily downtrend, and we know that this classifies the pullback as just a soft higher low. If the daily trend does flip to down and we pull back and can stay over 585, that would constitute a firm higher low pullback, and from there I would still look for trend continuation in the upward direction. An even better soft higher low or even consolidation phase on the weekly might remain over this 599 level in here for something like consolidation into a bull flag and then continuation in the upward direction. If we bring out the Fibonacci's from the bottom of the August 5th gap down, all of these reference points we've just described, namely the 585, remain well above the 38.2 Fibonacci. If we come in from the bottom of the election breakout bar, we'll call it, this, as we can see, now aligns with the 61.8. And as we know, the 61.8 is always the key line in the sand when it comes to a Fibonacci perspective. As long as you're above that, generally speaking, the odds would not favor a 100% retracement. The more weekly bars you close under that level, yes, in that case, the odds start to improve for the 100% retracement. But as of right now, this is not really a top priority. Once again, we've got a solid green-bodied bar that closed near the top end of the weekly range, a new all-time high close. We're looking for pullbacks that yield continuation, not a big crash in the S&P 500. If we remove some of these and bring out the anchored view apps on the weekly, we're above the entire cluster. There's not much to talk about over here. If we bring out the weekly volume profile and take a look, again, it should not come as much of a shock that we're in a low volume territory simply because these are uncharted prices. But if we were to get a pullback, there is somewhat of a semblance of a high volume node around that 585 soft higher low that we were just describing that would keep the weekly uptrend intact. Let's take a look on down at the daily time frame chart and firstly evaluate this week's expected move. Let me just make this a little easier on the eyes. If you're not familiar with the weekly expected move, it's this box right here shaded in gray, and you can check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 614.12, and that of course would imply a higher high, new all-time high. And if we're contained by the lower bound, the number's at 601.50, spot on the money there, nice round number. That's clearly a massive opportunity for a higher low in the daily trend count. So overall, the expected move does strike me as being far more bullish than bearish. Now, if we're thinking about the overall trend, very similar to the weekly time frame chart, we are in an overall uptrend. If you're counting lows, you have lows, higher lows. We really haven't pulled back on the hourly to produce a downtrend, so maybe this is a soft higher low, and this is a soft higher low over here, but generally speaking, any higher lows, I know not everybody's going to like this, but can technically persist even if a pullback looked all the way something along these lines. Would I like to see that? The answer is absolutely not, and a stronger level for a pullback actually would strike me as being this level right here. Previous resistance now has the opportunity to potentially act as support near the lower bound of this week's expected move. The technical level is just about $1 underneath the lower bound at $600.50. If we could spot buyers there, it would be an awesome opportunity to look for that higher low and then see if we can get trend continuation back in the upward direction. On Friday's session, I don't want to start calling for doom and gloom, but I would like to call out that we do have a bearish inverted hammer that looked over the Thursday high and then closed back inside of the Thursday range. Now, this is not the end of the world because you can actually see that on Thursday we had a very similar interaction with the Wednesday range, right? Let me get this even larger on the screen in front of us here. You looked over Wednesday's high on Thursday morning and yet closed back in the midpoint of Wednesday's range for Thursday's close. So as long as the market is what we call one time framing in the upward direction and the previous daily bar's low is not being breached, then I wouldn't be aggressively bearish. If we do take out the low of the Friday or even Thursday bar here, which you can see we have a minor level at 606.50, it would not strike me as being unreasonable for a pullback to develop to at minimum attempt to close the gap from Wednesday, which is a great segue since we missed the Wednesday midweek market update due to travel. Let's actually talk about that Wednesday session where the market clearly opened on a gap up. It produced a partial gap close and then closed where? Brand new all-time high, huge expansion of range to the upside relative to some of the ranges that we were seeing on the Monday and Tuesday session. If we had stronger sellers in this market, they should have closed that gap on Wednesday morning, and it simply did not take place. So as I'm looking at the charts, as I'm looking at all of the data points, it still strikes me that the S&P 500 is totally in control of the bulls right now, not necessarily threatening any major pullback or crash looking imminent. Any upside continuation, of course, you'll start to use the upper edge of the weekly expected move as a target. Once again, 614.12. The weekly and monthly bull flag measured move is at 610. We got close enough within spitting distance there towards Friday's highs. I'm not necessarily convinced that I would hold out on saying, okay, we need to make an additional, how large would the move be? 90-cent move to tag 610 on the money. We're close enough. Again, that was a monthly measured move. Very much so that, sort of has been fulfilled, I would argue, here on the daily. Let's drop this thing down to an hourly time frame chart. Let's see what else we can learn about the price action as this week was progressing. Once again, look at the Wednesday session. There was two things that happened on Wednesday actually that strike me as important and worth calling out here. Number one is, of course, the opening attempt to close the gap, but number two is the afternoon attempt. You can see in the lower wick of this 5th hourly bar of the day, there was actually an intraday liquidation break to the downside. Now, what that technically does is it brings in short-term momentum shorts, and if they are going to do their job, once again, we should have been looking for a gap close. We can clearly see that doesn't happen, and instead the market closes near the high of day on Wednesday. So short-term momentum shorts should have stopped out, likely back over this flat top from earlier in the session, which is our key level here at 606.50 for short-term pullbacks, right? Aside from that, Thursday and Friday, pretty much lackluster consolidation. The one thing I would say here is that on Thursday, we did close fairly weak towards that key level we were just describing. The fact that on Friday we opened above and actually did go on to produce a higher high would just lead me to believe, once again, stronger sellers aren't here. If we did have stronger sellers, maybe Friday opened here, put in consolidation, and threatened to break down on that session. It just didn't take place, as we've already called out. If we go ahead and talk about some pathing here, very, very straightforward as we're hanging out near all-time highs, basically at all-time highs. Any consolidation over 606.50, I remain bullish, looking for upside, again, 614 roughly, acting as a expected move upper target. Aside from that, we don't really have anything to be aiming at. If we're underneath 606.50, as mentioned, a pullback can develop to close this gap. Ideally, a gap fill reversal that then spots a higher low back over 606.50 would also be a bullish indication here. And you can trade for a short, let me just say, between A and B for the gap close. That's not unreasonable. If we do not see a gap fill reversal off of 604.15, which is technically the close, the gap begins at 605 here. If we go through that with a lower high underneath, that's where I would really start thinking about that stronger daily pullback to first look for that key higher low. Remember, it's not the line in the sand and higher low. It's just the one that would be ideal using previous resistance here as well as newfound support. This would be here at $600.50. Something like an inverted head and shoulders looks great. Hourly double bottom, simple hourly hammer candle down here. All of the classic signs of reversal are really in play at $600.50. So perhaps this begs the question, where would we have to change our tone? Where would we start being bearish in the S&P 500? Likely on some sort of attempt to get under $600.50. If we then spotted some sort of daily lower high underneath that level, that would be a larger cause for concern, and that's probably where I start to change my tone to being less optimistic and bullish and more sort of neutral at that point. I really wouldn't be bearish and pessimistic, noting that the weekly trend would still be up at that point in time. Let's zoom out on this a little bit because I do want to bring in a couple of alternate Fibonacci takes here. Coming from this pullback low up to the most recent high, if I could grab the right tool, that would help. Let's try that one more time. From here to here, notice the 38.2 is definitely within spitting distance of that $600.50 mark. Once again, to me, classifying it as the ideal daily higher low pullback if something were to persist, which once again, we're not really seeing signs of that just yet. A little bit lackluster as the market's trying to push to these highs. Remember, we talked about on the daily chart closing back inside of the prior day's range, but as long as we are not taking out the previous day's low, not a cause for concern yet. Let's bring in the intraday anchored VWAPs. This cluster is totally bringing in convergence at this $595 mark from over here. That's not as important, and the key would be if these slowly creep higher over time, and this might move really slow depending on how much volume commitment happens near these highs. We're talking about end of next week, maybe even the week after that. They will provide super support here at that key level we've already discussed, $600.50. I feel like I'm beating a dead horse about that one. If we come into the breakout bar, which was back here Friday of now 2 weeks ago, this anchored view app is right near the gap. So if we were to see a move under 606.50, gap fill reversal, and then higher low back above 606.50, that to me is also in play as being, certainly an opportunity for a higher low pullback to persist and keep the trend up in the grand scheme of things. So bulls on parade until proven otherwise. What do the market internals have to say about this? Check out the video tutorial in the top right hand corner if you're not familiar with this dashboard. But for the most part, the internals are slowing down. I think this is something that we want to start paying attention to. It's not an outright short signal. It's not a signal to say throw in the towel on the long side. But notice that every single day last week, Monday, Tuesday, Wednesday, Thursday, and even Friday here, we had a close on the volume flows that was negative. We spent a majority of the day on Thursday over the zero line, but that was about it. You can see the net volume flows on the week were technically out of the market. Now, I do want to call out here, as I just hover my cursor towards the very end of the week, you can see the net flows were 288. That's in terms of millions there. Substantial reads in the S&P, at least, are going to be 500 million or more, net positive or negative. So we did not have something substantial, even though they were technically negative on the week. If you look at the advanced decline line, it's a very similar comment here, where technically speaking, we spent a majority of the week under the zero line, and Friday failed to really hold over the zero line, even after what I would consider an impressive open back over 60.90, which is what we were talking about in the morning session. Not really the greatest show of strength out of the advanced decline line. The one caveat would just be that your index score, so intraday, this is when this matters most, intraday, you did have a majority of the week spent over the zero line, which sort of allows the market to move higher, right? This really focuses on, from the open, the heaviest weight and most influential components in the S&P. Similar commentary down here out of the tick. Once again, the point of doing all of this is to just say that, hey, as the markets made this advance through the span of last week, you're not really seeing that continued breadth expansion through the, what would it be, 493 other tickers outside of the Magnificent Seven. As a matter of fact, it looks like those tickers are actually slowing down a bit here, and we'll also see that on the RSP towards the end of today's analysis. So once again, not a short call, but just something to say, hey, maybe pay a little bit more attention to not allocating huge chunks of capital up here at the highest high, at the all-time high, until we get some sort of more meaningful pullback that allows for stronger buyers to enter this market with more conviction, right? As of right now, this is kind of a low conviction market across the other 493 other components of the S&P, although this measures at the exchange level from the NYSE, right? Anyways, continuing along, let's jump on over to the good old ES through the lens of market profile. If you're not familiar with the market profile, please check out the video tutorial in the top right-hand corner. Really powerful stuff. Once again, after missing the Wednesday midweek market update, I think it's worth calling out that the 2-day balance range resolves in the upward direction. Notice here that the value area was just overlapping. The point of control was nearly identical. On the Wednesday break to the upside, value area does progress in the upward direction, but what's the key here? The value does not progress to the upper portion of that Wednesday range, which is where we actually closed. So in my view, the fact that Thursday and Friday both held over the value area high from Wednesday, if I were to draw this in with a straight line, which hint, hint, there's that 60-90 level again. As long as the ES is over 60-90, then these traders are still okay. These traders here are still okay as well. I'd like to call out that we have a massive poor low and a poor high on the Friday session as well. So if a very interesting trade setup could potentially be, right? If we come in and if we sweep the low of the Friday session to repair the poor low, come back into range, the target would be what? Of course, the all-time high to repair the poor high. Now, if we sweep the low and find a lower high underneath, what would the target be? Probably thinking about, at minimum, some sort of pullback into this area, closer to about 67, give or take. 68 is the level we talked about in the pre-market preps, right? The 2-day highs would be influential, and also that would be the gap close, which we just talked about on the SPY cash as well when we were performing that analysis. Let's jump back on over to the platform here, and let's move along to the other major market component, the other market index that we track very closely, the QQQ, jumping it up to a weekly time frame chart. Thank you guys, as always, for bearing with me as I adjust the time frames on the fly. What do we see out of the QQQ weekly? So, huge theme of the week, which is absolutely worth talking about here. Look at the structure and look at the magnitude of the range there. There's a huge rotation into the technology sector last week, which really continued to fuel the market in the upward direction, even in the S&P 500, right? We'll see that small caps were a little bit lackluster. You can see energy took a little bit of a beating. You can see materials down a little bit here, healthcare, financials. A lot of money flowed out of those sectors, and it went directly into discretionary and primarily technology. So the QQQ seeing this massive rotation to the upside is very important because it went on to produce a brand new all-time high, which, as we know, the NASDAQ had been lagging for quite some time. So the new all-time high is impressive. Obviously, strong close from the buyers at the tippity top of the weekly range. If we're thinking about the bar-to-bar count, absolutely a higher low and a higher high, strong new all-time high close. Chart really speaks for itself. We can come in here with the Fibonacci's from the August 5th panic up to the high, well above the 38.2, which is still acting as somewhat confluence near the double bottom neckline from over here. As long as we're above that level, we're good to go. I would say on the weekly time frame chart, I would prefer that this soft higher low around 500 persists just like we talked about in the S&P 500. You had a little bit more of a threat for a daily downtrend over here, so I wouldn't call this soft, but anything that's over 500 to me would still yield a weekly higher low in the NASDAQ. If we take a look at a Fibonacci from the bottom of the election bar up to the most recent high, we'll just notice here that the 61.8, just like the S&P 500, is sort of tangled up near that key level. Let's come in here with the anchored VWAPs for the QQQ weekly, and we'll see what we can learn above the entire cluster. I'm likely going to have to start updating these, add one here possibly, and maybe one for this pullback as well. We'll tackle that next week. Let's come in here with a volume profile, and just to see where we're at relative to the pullback, if something were to come into here, it does make sense that that is the first major volume protrusion. We don't have anything to contend with through some of this other move back to the upside there. So really focusing on if we were to get a solid pullback, right, anything over 500 sort of keeps the weekly chart in check and moving in the upward direction. Let's take a look at the daily time frame chart, firstly evaluating the weekly expected move as always, jumping back over to the NASDAQ. Here we go. Let's take a look. Let's make this front and center on the screen, and we will begin. So here is the box, and if we're contained by the upper bound, 534.11. Obviously a new all-time high, higher high that's bullish, and the lower bound is at 518.83, implying a massive higher low, very similar to the S&P 500. This is a bullish weekly expected move. The trend, of course, remains in the upward direction. There is no concern with the daily trend. You have lows, higher lows, higher lows. Remember, we were a little bit cautious of the potential for a lower high here. Really, earlier on in the week, that Monday session, as soon as we produced the equal high instead, it sort of saved the chart from the potential for a daily trend reversal. If this had rolled over and moved down here, much more concerning. You would have had high and then a possible lower high here. Then all of a sudden, you could call it a double top, right? Underneath this neckline, the gates of hell basically open up with NASDAQ weakness. Not the case. Went on to produce a new high. This is about as bullish as it gets. gets, and it will continue the rotation being bullish in the S&P 500, even if things like financials and healthcare are slacking, being the other, in the top three heavyweight component sectors of the S&P 500. So looking at the chart currently, what do we have in front of us? Obviously, very strong close, much stronger than the S&P 500 on the Friday session, breaking out of a 3-bar play from the Wednesday-Thursday setup over those two equal highs at 523.75. There's really not much to be talking about here. The chart speaks for itself. Continuation, upper bound of the expected move, is really going to act as a target, 534.11 during this week's session. If we see a pullback, and if we were to take out the two, they're not quite exactly equal, but if we were to take out Thursday's low, which is at 521.85, that's where I would start looking for a pullback. And as we all know, coming from the highest high, we can afford a higher low pullback on the daily time frame chart. Gap fill reversal is underneath 519.60, closes the gap down here to 517.15, and even beyond that, just like the S&P 500, my ideal daily higher low is just anywhere over 514.85, right? Getting this pullback. Let's say that we close the gap and then test like this, and let's say that that's how the inverted head and shoulders plays out. Beautiful. As long as we're over 514.85, good to go. Looking for a DHL shipment. As we know, that stands for daily higher low. Could you get a daily higher low that still persists underneath that? The answer is absolutely, and 510 would really be the key area that I use. Something that looks like this would be your next that is the line in the sand for that higher low. Anything underneath that really starts to suggest too much of a failed breakout. The threat would then be what? And this is, please don't get hung up on what I'm drawing on the screen right now. This is very, very speculative. There's no indication of this currently, but if the trend were to flip on the daily time frame chart, it would likely require something like this that does not hold over 510. So very, again, straightforward chart. Continuation, pullback, gap fill reversal is interesting. Pullback, something that holds here, is interesting. And if you really want to play devil's advocate, yes, you could see a higher low that persists off of 510 as well. Pullback buys are the name of the game. They have been for quite a while. Let's drop it on down to the hourly time frame chart. First thing, to be congruent with the S&P 500, we'll just do this. We can all see, there's your 38.2, right at the key level we just described, 514.85, all set from that perspective. Nextly, let's jump into some of the price action analysis here, mainly focusing on Wednesday, since once again, we did not have that midweek market update. You got the gap and go. There's also not nearly as much of a liquidation break into the afternoon on the NASDAQ as there was in the S&P 500. So once again, what does this tell us? Do we have stronger sellers present in the market? The answer is absolutely not, which means that it's very likely that the upside grind continues in just the upward direction. You can see that we opened in range. So did the sellers have the opportunity on Friday for potentially just continued consolidation, or heck, even a pullback to test the top of the gap? Absolutely. You could have seen a rejection off of 523.75. You could have seen a look above and fail, lower high back in range. None of that stuff took place. So once again, who's in control of this market? I know I say it until I'm blue in the face. Buyers are in control of this market based on all of the evidence I can see from Wednesday and even the Friday session as well. Opening in range, in value, that was supposed to be a neutral open for the market. Buyers just ran away with it with high and tight consolidation into the afternoon as well. So as we had made note on the daily time frame chart, really speaks for itself. Hourly consolidation over 523.75 looks for upside. Anything that comes back down into range, I would not be inherently bearish. You could try a short if you'd like to close the gap, something that looks like this, but I would look for gap fill reversal off of 517.15 as we've already described. A little bit of an overshoot there is not the end of the world once again, something that looks like this here, and then holding 514.85, also a very reasonable outcome. So far, these things are the name of the game. This could also be a Brigade bolt here for an entry over the Friday high of day, which is closer to 526.50 as a possible reference point there. Anything that really is going to change the hourly trend to down needs to yield some sort of lower high beyond this pullback, right? So to play devil's advocate, and we just sort of get crazy with the pathing when we're like speculating on how things might change, right? This maybe sets up an hourly trend reversal. I would probably only change my tone to being more bearish if we do set some sort of clear hourly lower high and then get a break back down underneath 514.85. That's again a back pocket idea, considering that everything we've seen so far really aligns more so with the bullish side of the market than the bearish one. Let's jump into the intraday anchored view apps here, and really, these speak for themselves. Slowly over time, 510, which is that daily line in the sand for the higher low, beautiful confluence there. But what we can do is actually move this anchored view app one notch forward. I think we can cheat the system and just do that. Yep. So on the breakout day, notice that this is at the top of the gap. So is it possible that you just find support over the gap? The gap does not close? Absolutely. 519.60 should be carried forward as a key level for potential support as well. Again, it's insane that I have to keep saying it, but it's just bullish pullbacks until proven otherwise, right? That's the MO whenever the market's making these highs like this. If we look at the market internals for the NASDAQ side of things, a much stronger show of strength with decent inflows on Wednesday as well as the Friday session when both of those big breakouts, the gap and go and the move higher on Friday, were taking place. You're getting much more support at the exchange level on the NASDAQ side of things. You can see on Wednesday, the advanced decline line stays in the positive territory as it does on Friday, unlike the S&P, which was negative all 5 of the sessions. The advanced decline line is not great. The cumulative build out of the tick is not great, but they are the most flat on the Wednesday and Friday sessions. And Monday is also decent as it's breaking out of the previous days, or the previous balance range from underneath. So actually we can read into the Monday volume flows here as well. Advanced decline line is positive. So much more support, broadly speaking, in the technology side of the market, which, as we know, is the heaviest weight risk-on component of the S&P 500. So if you're looking at the S&P sort of baffled and saying, like, oh my goodness, why is this thing not crashing? I mean, this speaks volumes. This is your answer. The rotation into tech is what's going to keep the S&P market propped up, right? And the beautiful part about this, not to get too much into the sectors ahead of time, is just that if the XLF pullback is over, if they've sold enough financials and they've bought enough technology, that rotation inverts. And then if they go back into buying financials, what do you think happens to the S&P 500? It remains afloat again. You need selling across all of the heavyweight components if the S&P 500 is going to crash, and we just don't have any signs of that as of right now. So a little bit of a sidebar there, but let's finish up the NASDAQ with, of course, the market profile. Let's jump on over to the NQTPO. Let's jump this over to this. There's going to be a couple of glaring differences that I just want to highlight here out of the NASDAQ before we jump into the Russell. Of course, P-shaped profile is mostly indicative of short squeeze. What I like about this, though, is just that it's not total short squeeze because value is higher, and then we confirm it the next day. So this is possibly new money buyers getting involved there. If you had just short covering and not new money buyers committed to price up here, this A-period break underneath the value area low on Tuesday should have yielded lower prices to sort of topple the heavyweight overhead supply in the NASDAQ. It just simply didn't happen. So the next big test of this, of course, will be what happens on Monday relative to the value area from Friday. So Friday is a P-shaped profile. Again, short squeeze. It'll be easy to topple over if you move underneath the value area low, which is somewhere around 21.6. If you get a break below that, it's all a question of, okay, does value on the Monday session stay here? Even if we explore prices down here and we get a close back in there, in which case, probably looking for higher. If it topples and value shifts to here, okay, where's your short? Probably underneath this level here, which is closer to the Thursday low that we were just describing on the QQQ hourly chart. Your NQ level is at 21,450. 21,450 roughly on the NQ, right? Let's finish up the broad market here with none other than the Rusty Russell and see what's going on from that perspective. Jumping on up to a weekly time frame chart here. Okay week. I'd say more of a consolidative week than anything else. Let's zoom in a little bit. So what do we see in terms of candle structure and location? So one of these things is not like the other, obviously. Red-bodied bar here out of the IWM small caps, closing weak on the lows, technically making a bar-to-bar lower low and a bar-to-bar lower high. So bears do have the upper hand here in the short term bar-to-bar count on the weekly. However, if we're being honest with ourselves, is the chart moving from lower left to upper right, or is it moving from upper left to lower right? I think we can all agree it's still technically in an uptrend on the weekly, and as we've described, as long as we're over this key level, I really don't see any issues with the IWM small caps. I mean, we've gone for an impressive breakout. We've finally produced a brand new all-time high back here. If there is digestion or a pullback that remains over, roughly 227 is the level that I was using. As long as we're over 227, good to go on the weekly time frame chart, keeping the uptrend intact. A couple of Fibonacci's we can reference. Here's the August 5th to the most recent high. 38.2 is right there. And if we come in from the election cycle to this high, 61.8 is also confluence with that exact level. Good to go from that perspective. Let's jump in here with the anchored VWAPs on the IWM weekly. These are, again, going to start meeting us right around that key zone. So I'm not seeing any glaring issues yet for the IWM other than the fact that we have short-term consolidation or neutrality instead of continuation like what we've seen in the NASDAQ and the S&P 500. If the IWM is going to be a hang-up for any of the other major market indexes, it's going to be the S&P, not necessarily the QQQ NASDAQ, of course. Let's go ahead and throw on our good old volume profile, and let's grab a little bit more time on this one because we do want to reference the previous all-time high, this from back here. So where are we relative to like this huge volume push, this back here? We're still well above. Notice how this also aligns loosely with the top end of this range from back here. I'd give that a little bit of a zone. Once again, over roughly 227, we're all set on the IWM. We're also not falling back down into the high volume node. Ideally, we build out a new high volume node here and then push for continuation into blue sky territories if you're a bull in small caps. So still bullish here in the grand scheme of things on smalls. Let's drop it down to a daily time frame chart. Let's see what else we can learn as Thinkorswim lags and loads for us. Thank you very much. Usually they perform maintenance on a Saturday, so pretty thankful that we can squeak in the videos here ahead of that. Anyways, weekly expected move is at the upper bound, 243.98, and at the lower bound, 233.85. Some interesting concerns here, noting that we have an equal high projected and some kind of still higher low, but you get into just range compression at this point. Ideally, and this is why we still have it labeled here on the IWM, not labeled in any of the other indices, the daily higher low line in the sand is very critical here. Obviously, with the broad market outside of small caps continuing in the upward direction, you don't want too much divergence. So if this does pull back, it needs to hold on the daily this 236, and that to me would continue to persist a daily higher low, in which case we would need a rotation back up to the equal high, the upper edge of the weekly expected move, the all-time high, which is up there around 244.46. If we could break out over that, it's a blue sky territory move, and it's rock and roll bulls on parade that will act as a tailwind for the S&P 500. What I find most interesting about this is just the fact that on Thursday we broke down underneath the flat lows of this 239.30. Then on Friday we opened back above. We technically just have an inside bar on Friday. It's not the most impressive thing I've ever seen in the world, but generally speaking, if stronger sellers were here, if they were going to accelerate in small caps, then the Thursday breakdown should have been the first catalyst, the major, the first domino to fall for some sort of more aggressive rotation through this thin structure. As a matter of fact, let's just drop it down to the hourly so we can see this, right? You have overhead supply. You call this whatever you want, but descending triangle, right? That's technically there, making lower highs into these equal lows. You break down on Thursday. Friday does not accelerate back down underneath 239.30. I'm not going to sit here and argue that we got price acceptance back over the level. We absolutely did not. But look left. This thin structure should be a threat, right? There should be an ease for this pullback to unfold, and it simply did not take place. So the saving grace, if you're a bull in small caps, is that you want to see a look below and fail. Something that looks like this is very opportune for buyers, and if we could spot a higher low back over 239.30 once again, that's definitely bulls on parade in the S&P 500, acting as a major tailwind back to the top end of the balance range here. Let's come in with the Fibonacci's just to check in. That is a tongue twister if you say it too fast. On where the 38.2 is, it is right where we actually found support there. The 50% retracement is that daily higher low line in the sand, 236 level, and on the weekly we were talking about 227, right? So that's why that's still labeled down here. Generally speaking, no strong concerns yet, but definitely noting the relative weakness, again, compared to the S&P and the NASDAQ here in the small caps. Let's come in here with the anchored VWAPs on the intraday and see what else we can learn. The cluster is right here near the daily higher low line in the sand, so I'd love to see if this could come in, test, support, and then rotate back to the upside. Bulls on parade. Daily higher low, rock and roll, the trend remains up, and I'd probably be thinking about new all-time highs, especially depending on next week how the CPI data comes in. Is Jerome Powell likely to cut rates in December? As of right now, the labor report from last week says absolutely yes. We'll see if that can make a little bit of a positive impact on small caps moving back in the upward direction. So key levels here, just to keep it simple, 236 and 239.30 will be the determining factors here out of small caps into this upcoming week. Let's jump on into the Rusty Russell market internals and see what's going on from this perspective. We can see over here very lackluster volume flows net on the week, about 2.6 million. That's nothing in terms of a net flow. Individual sessions not doing anything impressive. really tangled up, a little above, a little below, a little above, a little below, really lackluster out of the advanced decline line. Even the cumulative tick is, a little bit leaning more so bearish, but nothing major. And that sort of seems like a theme through a majority of these indices that we've seen here. So is there any overwhelming edge to the selling pressure as this mild drift to the downside has taken place? No. If we had stronger volume outflows, negative 125 million a couple days in a row, if the advanced decline line was pegged down here in trend lower zone, I'd be shouting from the rooftops, oh my God, watch out, look out for the Russell, it's this big threat. It's just not as of right now. Let's move on over to the market profile for the Rusty Russell futures, and we will see what's going on from this point of view. Just a slow malaise in the downward direction. There's really not much, there's not much else to say other than, hey, there's a little bit of a breakdown happening here. One interesting thing perhaps is just that point of control did stay higher relative to the Thursday breakdown. The M period represents a pretty decent amount of excess there, that spike, if you will. If you think about spike rules, right? Spike was rejected. Value is back over the spike. So if anything, this might actually lean into more of the bullish nature of it's been a mild pullback, and now we're looking for a rotation back to the upside in small caps, which will help the case for the good old S&P 500. So a little bit of spike analysis there for you on the Rusty Russell futures. Let's jump back on over to the S&P 500. We'll talk about the supporting evidence categories, and we'll get into the sectors. Let's kick it off with the weekly performance here. At the top end of the list is none other than the XLY. What an absolutely monster move. We'll look at that chart in just a moment. That is a heavier weight risk on component of the S&P 500. That is bullish. The XLK up 2.97%. The heaviest weight risk on component of the S&P 500. Again, it's about as bullish as it gets. Communications, another not so heavy weight, but medium tier weight. Risk on component, though, of the S&P 500, absolutely bullish for the market as we march forward. Semiconductors, although we're talking about that weakness in the introduction there, generally speaking, nice performance on the week. At the bottom end of the barrel, it's energy, utilities, materials. All three of those are very lightweight and D for defensive sectors anyways. There's really not a lot of defensive posturing taking place here. The rotation is absolutely risk on, and it's absolutely bullish. Let's take a look at that XLY crazy chart that we were just mentioning. What do we have? Well, to me, it's nothing more than a bull flag breakout into blue sky territories. There's nothing bearish to say about this chart. Could you get a pullback? Absolutely. I'm not blind to the fact that the parabolic breakout's not going to last forever. Of course it won't. But a pullback just offers an opportunity for a higher low and a stronger launch pad for new money buyers to get involved. So any concerns with this chart? The answer is no. XLK, zooming in, gap and go on that Wednesday session, just like the QQQ, getting consolidation over the previous all-time high. Looks bullish to me. Even on a gap fill reversal, we have a higher low. Even on a test of 234, we have a higher low. I like what's going on here. It's not as strong as the XLY, noting the inverted hammer from the Friday session. It's not enough for me to be bearish and say, oh my goodness, markets are going to crash and go to zero, but it would be enough for me to say, hey, if we start to see early week a bit of a gap close, just be mindful that your S&P and your NASDAQ might cool off. We've seen a substantial break to new all-time highs. Some consolidation is A-okay. It's not the end of the world. Let's take a look at the XLC, right? We want to be these buyers of these higher low pullbacks. So like these things are welcome. Please pull back. Please show me the gap fill reversal. Please give me these better entry points, right? That should be the mentality here. XLC. Break the new all-time highs. Looks like a little 5G loading bar here at the top right-hand corner of your phone. Looks good. I mean, nothing, rinse and repeat of everything else. If it snaps $100, psychological level, thin structure retracement, do we get a higher low here? The answer is absolutely no concerns. SMH, shake my head. Oh, it's between a rock and a hard place, right? As we know, the relative strength, the relative trend performance has dramatically degraded from 10 to 0, as we saw in that introduction little graphic there, and that's from Sentiment Trader, by the way. What does that suggest? Well, we're not even close to all-time highs. Technically, this balance range is still giving us some problems. We have the opportunity still for a potential lower high happening here, but we also, on the optimistic front, say, okay, we're holding the daily 200 SMA. We're back inside of the defining balance range from back here. If the market is going to remain constructive, it needs to, notice the emphasis on needs there, it needs to hold 245. If you could spot a higher low over 245, then great, call this for what it is. It's a double bottom neckline retest, and then we rotate to the top end of the range. And then what's the next need to have step? Well, if the market's going to remain bullish, if semiconductors are going to continue to be a linchpin for the market, which they absolutely are, just think about the heaviest weight component of the S&P 500, NVIDIA. If that's the case, then you need to see this continuation starting to work its way back towards this overhead gap. If you do not, if you start to see price acceptance under 245, then the rotation just needs to immediately reverse. You need to see inflows massively into the financial sector. You need to see healthcare rotation. That'll keep the S&P 500 afloat, but your NASDAQ is likely going to suffer. So semiconductors right now really are walking a fine line between like keeping things okay, but needing to start showing some improvement here sooner rather than later. Otherwise, as we know, it's very easy to build an argument for, okay, if semis are not participating, might not get the strongest continuation moves out of the S&P 500 walking forward. The only saving grace is really, when it comes to things like Tesla, when it comes to Amazon and Apple actually breaking to those new highs, some of those Magnificent Seven heavyweight components pushing the S&P 500 higher. So semiconductors, they're a top watch here around 245 into the early stages this week. Here's the TLT, the 20-year bond, of course, getting a breakout on that Friday session there, moving higher with the release, if you will, of the labor report. If you believe it was leaked on Thursday, then so be it. But regardless, gap fill reversal, holding over 94. This means that interest rates are coming down. We're still not seeing a dramatic outperformance here from the S&P 500. It's not a total flight to safety, but it's something to continue to keep eyes on. Let's jump into the energy sector, crashing, absolutely getting annihilated here, which technically is okay from, what would you say, prices and inflation. However, global demand for energy, you don't want to see that make a new low. So I'd say inside of this congestion is okay. Gap fill reversal is okay. But you really don't want to see energy prices, in my opinion, back down underneath something like 87.75. That to me starts to become a little bit more of, does the recession theme start to come back into view? We could quickly check in on something like the CL, of course, and just see what's going on back over here. You want to avoid a large breakdown underneath these big equal lows, which are closer to about 66. Underneath 66, it starts to get a little bit hairy here with the question coming back into play, global demand for oil. When I say global, I really mean that intentionally. The U.S. market has been somewhat insulated from any of these recessionary themes, but if you look at things like, Europe, if you look at some of Asia, really not performing well by any stretch of the imagination relative to the United States markets, the American markets here. So just something to keep in mind. It truly does. When I say global demand for oil, I mean it. I'm not just talking about the U.S., so I'm trying to make that distinction, right? Here's the XLU, what's going on with utilities, right? And so therefore, I guess the bottom line of that statement is just that if we see that energy is breaking down aggressively, it's such a lightweight component of the S&P 500 U.S. market that it's probably not enough to cause a crash/recession here in the United States, right? But globally, you could spot other segments of pain. That's the main point. Anyways, utilities coming in. Is this D for defensive? It absolutely is. Is this a cause for concern? No, it is not. Let's take a look at materials. This is a little bit more cyclical side of the economy, so worth keeping tabs on. Would not want to see a new swing low underneath 91. It is technically remaining in a daily downtrend. Double top, lower high, lows, lower lows, lower lows. Equal low should be the target at 91, but you really don't want to go underneath. Would have been best if this held up over 93.60, so carrying that forward as a small sore spot in the market. Industrials, not quite as bad, but ideally a higher low would have been 141.60 for consolidation. You can see this more clearly on the hourly chart, actually. Here you go. Previous rejection, support, a little bit of dance happening over here. It would have been best to hold over that for consolidation and continuation. Not the end of the world. Once again, a lighter weight sector, about 8% of the S&P relative to the XLK, which is 30% plus of the S&P 500. Not the worst thing I've ever seen. So is the trend overall up? The answer is yes. We're moving along. Real estate, rate sensitive, even as rates come down a little bit. Real estate's coming down a little bit in the midpoint of the range. Once again, these lightweight sectors become more concerning or worth paying more attention to when they make a new swing or pivot high. XLV. Healthcare, unfortunately, did what I was afraid of, is the big-time lower high at the daily 200, a big-time lower high underneath, a pretty key area of previous resistance, tried to act as support a few times over here. This, of course, is in the aftermath of the RFK announcement. So, generally speaking, I would still be somewhat pessimistic here in the XLV. The only saving grace for the S&P is that, yes, it might be, and please correct me in the chat if I'm wrong. I just looked at the stat the other day, but it's not coming to memory right now. Is the XLV now the fourth heaviest weight sector? Did the XLY overtake it? I believe they did. But with the XLV coming down so aggressively here, it's a lighter heavyweight component, and it's also D for defensive. So is it the end of the world to see this down here? Not really. Do we want to see it down here? No. Ultimately, upward pressure is upward pressure for the S&P, but if any of the sectors were going to be lagging so dramatically from the heavyweight quadrant up towards the top, this is the one to do it. So we're okay from that point of view. Here's the XLF. Not the best looking chart on the pullback, but still okay over this. The reason I say not the best is just because this should have acted as your continuation launch pad there. And we'll see something similar on JP Morgan, of course, momentarily. So as long as we can hold over $50.10, good to go, not the end of the world. I would be spotting this and saying, hey, it's a DHL shipment, and we're looking for that next leg in the upward direction. Please show us the logistics back to 5110. 5150, my apologies. If that can take place, then rock and roll once again. This is a bullish tailwind for the S&P 500. So we spent some time today going through the sectors, and we actually didn't finish. Here's the XLP. Let me not forget about the final sector in the lineup. Is it going to load? The answer is yes. There we go. Once again, think or swim. A little bit of maintenance on a Saturday session. Where is it relative to this range? Smack in the midpoint. Ideally, consolidation back over 82.55 gets continuation. We're not there yet. Midpoint here is just neutral. I would start to become a little bit more bearish as a headwind for the market underneath 81.50. Not there yet. What I was saying is that we've spent some time talking about the sectors intentionally because we missed the Wednesday video. I just want to point out that nothing is detrimental there. We're seeing a beautiful rotation into technology, and even the XLF, the second heaviest weight component of the market right now, is looking okay with the opportunity for a clear daily higher low. The XLK relative strength is being reflected in the ratio over here. XLV is a non-issue. XLF has pulled back, but still has the opportunity for what I would just consider at this point a weekly higher low. Still aligns with the structural chart also, and the XLY is simply just moving off the charts here. Bullish risk on rotation. You're not seeing a risk off rotation happening down here, nor over here. That is a non-issue. Energy getting beat up a little bit. Hard assets are not getting rotated into either. Let's take a look at the specialized ratios over here as this loads up. This SHY, and come on, give me some love there. We'll let that simmer, but for the most part, risk on, risk on, risk on. Are you going to work out? Yes, no, maybe so. I'll give you the heads up. It's risk. Oh, there we go. It is risk on. If you look at emerging markets, we had some struggles with China over here. However, things have really turned back around. And one thing I do want to point out, let me just go full screen on this for a moment. Let's go over to USD JPY. If I could spell JP, come on, there we are. Is it the other way around? Is it JPY USD? Come on, work with me here. Don't make me look silly live on air. Is there a slash in there? Am I mistaken? Is there a... There it is. It's a slash. My apologies, folks. There was some cause for concern back here about the panic coming back in when there was some Japanese, I think it was the Tokyo inflation rate came in way hotter than the expectation, putting some pressure on the currency. So the yen carry trade was back in question over here. But notice that there's a strong opportunity to just support over this congestion. As long as we're over 149.25, I wouldn't really be overly concerned with the yen carry trade unwinding further. The Nikkei as well, if we just go over here, is a decent way to continue monitoring this. This is when the yen carry trade was like, oh my God, in August, it's the end of the world. Look at where the market, generally speaking, is trading now over in the Nikkei, right? It's just not a cause for concern. It's putting in consolidation. It's back in its comfort zone back here. Not really a cause for concern. So I did want to address that here during today's episode of the weekly watch list. Let's jump into the QQQ versus IWM, just in terms of relative performance. The NASDAQ starting to perform well again. And again, with this rotation into tech, I would expect that to continue, especially if the IWM, based on the weekly chart we just saw, is taking a bit of a breather, bit of a pause. So tech leadership is bullish for markets overall, and that's something to continue to keep tabs on. Let's move into the dollar. Supporting over 105.65. So some dollar headwind is still a threat, but with the prospect of rate cuts, perhaps this starts to come in a little bit further. Let's quickly check in. I'm going to invert our lineup here. Let's go to the TNX first, and then we'll go back to gold here. The TNX coming in, the 10-year, right, coming in a little bit. So I wouldn't be shocked if this rate cut, again, is continuing to be priced in very heavily, which it is, about 80% odds last time I checked for the December 18th meeting. The interest rate should continue to move in the downward direction. Just bonds should continue to catch a little bit of a bid here, and that should, in theory, put the pressure on the downside for U.S. dollars, allowing equities, or at least, from the perspective of the earnings valuation of the market, continuing to move in the upward direction, right? Let's go ahead and take a look now at gold just to continue the flight to safety style analysis. Are we getting anything here from hard assets? The answer is no on a relative basis. Performance-wise, gold has not seen this big uptick on the rally back to the upside. So equities are still the preference down here. Now let's get into the Fed tracker tool. I know that the order there may have been a little bit skewed, but I wanted to tie the dollar and interest rates together. Anyways, here is the update. 86%, so I'll have to eat my words there. Another 6% going to the doves here, looking for a 25 basis point cut in the December meeting. Once again, folks, one of the sneaky ways that you need to continue monitoring this is what happens with this down here. I'm literally pointing to a year out, December 10th, 2025. Do the odds shift from here to here? Do we start pricing in, only 2 cuts in 2025? Do we have 3 cuts in 2025? That's really the next major way to look at the curve here of the Fed probabilities and say, okay, what is the future expectation of interest rate paths, right? For now, I will say it does look like we will get that cut, and I don't know exactly how to feel about it. I say that because if we take a look at the fundamental data, the labor report came in fine. You're not really seeing any issues out of JOLTS. The ADP non-farm really wasn't a huge miss from the expectation there. If we take a look at the unemployment claims, they came in a little bit hot, but nothing crazy. If I just open up this window here, well in line with reasonable expectations. This was the weather situation we were dealing with in early October. As we look to the full Monty report from Friday, this is where I honestly don't really see many issues. The NFP, the true government read here, at 227 versus 218, that's way above the expectation, especially noting that the continued jobless claims really were not relenting through a majority of the November timeframe. So it seemed as though hiring was actually slower, and beating the expectation here strikes me as a little bit of a surprise. Prior, revised from 12,000, remember it was 12,000, revised up to 36,000, and the unemployment rate coming up to a 4.2, which is still well within the threshold of what the Fed was expecting this year based on their SCP projections. So I don't really see a reason to increase the odds of a 25 basis point rate cut, as the labor market seems to be in line with the expectations of the Fed, not breaking aggressively. And as we know, this upcoming week, what we have to look forward to is the inflation rate. CPI inflation comes out. This is the final full big report before the Fed makes their decision in the following week. Inflation, as we know, has really stagnated, and we're actually expecting a year-over-year uptick on CPI. Right, 2.7 from 2.6. All of the metrics that we continue to watch. It's shelter and insurance inflation that continues to be the issue. I don't see why the Fed would be, overly thrilled or chomping at the bit to basically cut rates 25 basis points when I truly don't believe that rates are as restrictive as maybe they believe. So who am I to say? I'm just a guy on the internet analyzing things that I see in front of me. They are ultimately the Fed. Let's take a look through Let's take a look through some of the other indications here, some different data spreads. So the JOLTS by industry, of course, we saw that little uptick there out of the JOLTS, but still relatively elevated, well above the at the previous trend high from pre-pandemic. If we look over here, job openings per unemployed person is back to about parity, getting closer to about 1-to-1. So still plenty, or I shouldn't say plenty, but there are enough jobs to satisfy the unemployed population out there who is actively seeking. However, as we take a look, this is not what we want yet. We want this over here. This is the unemployment rate, and really what I wanted to bring this one in for is the underemployment rate. So when I say that there's a 1-to-1 opening between jobs and unemployed people, there's technically more underemployment that can take place here. Would not be a shock to see this tick in the upward direction as that JOLTS comes further into this parity, just noting that not all jobs are obviously created equal for the people applying to them. Anyways, small uptick down here, but still relatively unchanged. I mean, the unemployment rate has been very stable around this 4.1, 4.2 for quite some time. It's not really enough to re-trigger the SOM rule, which we had talked about in previous episodes. You did see over here a couple of the other screenshots I was looking at. This is the PMI report on the services side, and notice that we are getting prices paid remaining stagnant. That's the yellow line versus new orders, which is the blue line ticking down. So that divergence between the two is just kind of indicative that maybe a little bit more inflation from the services side of things as prices remain elevated, but orders not really responding to that as well. It'd be different if orders also saw an uptick or at least sideways, not the case. This is the breakdown of the NFP, the full report, and what we were focusing on when the report actually came out was just the fact that the government number wasn't overly padding the results results here. You can see plenty of jobs added in professional and business. You can see manufacturing, financial activities, construction, think cyclical, leisure and hospitality as we come into the holiday season, right? So you're getting plenty of this uptick here. The one thing that was a downtick is your trade, transportation, and utility. So generally speaking, a healthy move back to the upside out of the NFP, and not really enough for me to believe that it would be appropriate or overly appropriate for the Fed to say, oh my goodness, we need to be, let's get these rates down, let's get them down fast. Why? What's the rush? What is the rush? We're still dealing with, in my opinion, inflation that they should not be accepting of. They should be saying, no, inflation's still too much of a risk. Anyways, here's the earnings calendar for the upcoming week. C3AI, honorable mention there, but really, Oracle is the main name to watch on Monday after the close. Get your popcorn out for GameStop. Keith Gill was tweeting some funky Time magazine cover this week. Crazy. I don't know what he thinks is going on here. I suppose maybe you want some earnings volatility to play around in, whatever. Get your popcorn out for that one. We've got Adobe here on Wednesday after the close, worth watching for. Broadcom, AVGO will be huge. Costco will be important as well. Restoration Hardware will likely have some insights into the higher tier consumer and whether or not spending is slowing or increasing. Let's jump back on over to the platform and let's take a look. I do want to show you this just for the sake of bringing it up. So here's your SOM rule, which is back below that 50% mark, or it's just 0.5 down here, and that's likely going to remain there on the 4.2. Even a small uptick is probably not going to bring it back over. I'll update you if it does, but these moving averages are still in the upward direction here. You got the cross between the 24 months, so the 2-year and the 1-year rolling average of the unemployment rate. Usually, it becomes difficult to put the genie back in the bottle, but if this can stabilize and just go sideways, if these can tangle, who knows? Dare I say the infamous words? Is this time going to be different? I don't know. I'm not convinced that unemployment is at a steep enough issue yet where we'd have a dooming and looming recession incoming. Anyhow, let's jump into the traditional indications we follow up with. TLT ratio to the S&P, as we mentioned earlier, getting some outperformance there, but nothing in a big way. It would have to take this out for me to be more concerned, so all set on that. If we look at bonds relative to themselves, they're moving lower, which to me is the market saying, hey, we're actually in a decent spot now to battle inflation. Which is kind of funky because the Fed tracker tool, of course, increased the odds for the 25 basis point cut. So that one's sort of a bit of a head scratcher. Maybe it's a higher low pullback in a developing new uptrend. But for now, at face value, these downtrends, if they can persist, would be bullish for markets down below. Let's jump into... come on, play nicely here. Let's jump into credit spreads, continuing the downtrend, meaning that volatility should continue to contract. Not a big issue over there. If we look at HYG in isolation, a little bit of a bearish divergence happening here. This is about the only bearish divergence I can spot across the broad market that we're seeing. Not really enough to me to go all in short and say, hey, it's this big top. Nope, not there yet. Here is the Bitcoin chart continuing to break out to new highs. We hit the $100,000 mark, not just in the futures, but actually in the coin itself, based on a couple of the different exchanges. You could use Coinbase. I don't know if Kraken is still out there, Binance. A lot of those exchanges got Bitcoin up and over 100,000, and now we're just getting a little bit of volatility to settle it out sideways. So as of right now, Bitcoin still continues to signal more of a risk-on appetite for equities down below, or just generally financial instruments as a whole. If we look at total breadth, small contraction this week. What does this align with? I know it feels like we were talking about it eons ago, so thanks for bearing with me through the full length of the video. But we talked about on the NYSE internals dashboard that breadth looked like it had contracted. Well, obviously, you can see that here reflected in the data points as well. So this is making sense. If we take a look at the RSP, the equal weight, it's pulled back already into this previous high versus the S&P weighted, which has not. So in my view, this needs to hold right here, right now. We need to see a turn early in the week on the RSP if, generally speaking, this trend is going to continue. Otherwise, I would not be bearish in the S&P 500, but I would be saying, hey, a pullback is more likely because this is not holding its key level. Right, so the RSP has some insights for us here into the upcoming week's worth of trade. The QQQE is similar in the sense where you are getting that pullback that's already respected this, whereas in the weighted, you have not even tested it in the first place. But remember that the full rotation was into the technology sector last week, so this doesn't strike me as being as concerning relative to the RSP. Here's the Dow Jones, industrials versus transports, a little bit of that divergence, very similar to the breadth concern that we were just talking about, but also a little bit of the HYG concern that we had also with the junk bonds. So two small minor bearish divergences, but not enough through the full data point collection that we've gone through to say, hey, the market's a short this upcoming week. It might be a pullback, but it's probably not a big short flipping into a downtrend. VIX moving to the downside, breaking to a new not 52-week low, but we're making new, is it 6-month lows? Not quite 6-month. New 4-month lows. How about that? 3-month lows. We could confidently say that one. So new lows out of the VIX. Volatility down means equities up, generally speaking. If we take a look at the VVIX, continuing to drift to the downside happening here. Small uptick on Friday, but I would really argue that's on the heels of the labor report coming out, not necessarily inherent volatility to the market. If we look at the volatility futures, huge contango agreement here, and some of the lowest prints we've seen in a very long time out of the one-day VIX as well. So is volatility an issue? Are money managers somewhat concerned about the future prospects of returns in the market? As of right now, no. There's more unknown risk in the future than there is in the present day, and that would certainly mean that it's better to allocate capital now rather than later. Let's jump on over to the core list of companies, and let's see what's going on from this perspective. NVIDIA, the top dog, is going to kick us off. What do we see out of this balance range here? We're literally in the midpoint of the range. So NVIDIA, I'm hesitant to call it dead money. I don't want to call it dead money. It still is technically trending on the weekly time frame chart. However, it's not really doing anything impressive on the daily. If this is going to play nicely and in tandem with the SMH, you cannot afford to have NVIDIA underneath 137.25. As a matter of fact, it probably just needs to hold here at 141.15. Why? If you take a look at the hourly time frame chart, and we were shouting from the rooftops about this one over on X, the old Bird app, so you can follow us there. It's linked down below in the description. But the inverted head and shoulders, right? This was in play. Strong move on Wednesday. I'm honestly a little bit sour that I was traveling and flying on Wednesday, but beautiful gap fill reversal, held the previous day's highs, rallied straight into the target. Now we're getting a retest of the neckline here. So ideally, NVIDIA holds up over 141.15. It did pull back on Friday. You did start to get some response from the buyers off of that level. So as long as we're above that, I think we're okay. And the rotation would be back here. Show me the daily high or low, then continuation in the upward direction. If you want to be bearish, what you would look for is a lower high rejection there to set up an hourly double top under the neckline, sinks the ship. And that would be here underneath the Thursday consolidation range at 144.50. All right, buyers need to see it back above. Great equal high breakout. It's bulls on parade, pretty standard stuff. Sellers show the lower high, equal low breakdown. Again, gates of hell open up. Let's take a look at Microsoft. What's going on with Softy? It's trying to get in gear out of this range. So if the broad market is going to continue in the upward direction, one of the prospects of getting that job done basically is Microsoft continuing its sort of journey back towards the all-time high. If this is truly going to be a breakout of this congested range, I mean, Microsoft really hasn't done anything since I don't want to call it a crash, but the devastating earnings gap down from over here mid to late summer, Microsoft has done absolutely nothing. If it can lift out of this base and get back towards the all-time highs, that again will be the rotation. It will be the fuel to the fire that causes your S&P 500 to remain bullish. It might not be NVIDIA anymore. It might be Microsoft. It might be the top dog here turns into Softy, the AI play. So looking at the daily chart, inverted hammer on Friday, pullback fine. Daily higher lows persist over 432. If you look at the hourly time frame chart, there's an even better way to view it. It's just consolidate here, continue in the upward direction. If you pull back to here, you pretty much have to hold 438 for that higher low. Otherwise, I think you set too much of a risk of what? Good old head and shoulders under the neckline gets you the daily higher low pullback in the first place. So primary outcomes here out of Microsoft. Show me the love like this, get back to the all-time high. If you pull back, fine. I'll do the dance here one more time, probably entering that 41.50 higher low. If you're underneath with a lower high, okay, looking for the daily higher low, the stronger entry point is back down here around 432, 429.30. Let's move along to Apple. What's going on with AAPL, the breakout everybody saw coming. I'm happy to have added a little bit to the long-term account ahead of the breakout, but I mean, geez. I have to start trusting these things with some even if they're leaps, longer dated options. Obviously nothing that's like weeklies for these swing style moves, but man, look at that nice solid break earlier on in the week. 3 days of consolidation into the end of the week. A pullback that looks like this. Pretty textbook stuff. Brigade bolt over the previous all-time high. No reason to be short in Apple. You could try to be quick draw McGraw. You could try to get cute. You could try to get fancy with it and try to trade pullback from A to B. Be my guest under 241.25 into 236.50, but I would prefer to be the pullback buyer here with more confidence saying, okay, risk and reward back to the upside, trying to balloon runners into brand new all-time highs. Apple, is it coming back? Possibly. New all-time high breakout does strike me as being interesting for the broad market story, continuing in the upward direction. Next up, Amazon. Oh, we saw the XLY chart, didn't we? This is a major component of that. Just gap and go, gap and go, gap and go. A lot of yellow lines on this screen. It speaks for itself. Obviously, all-time highs means that pullbacks can persist. Daily higher lows. Ideally, the daily higher low is this gap fill reversal. That's under 215.75, closes 214. Here it is on the hourly time frame chart. You can see that consolidation here, great, persists over the intraday resistance. That's 225.25, blue sky breakout. If you're underneath that, maybe there's a pullback to test 220. Something like this, back to the upside, right? You could try from A to B. You could try these shorts, but please understand that you are stepping in front of a moving freight train. It would not be my preference. I would prefer to be a pullback long buyer, a breakout buyer even. Amazon clearly has momentum behind it right now. Long is the way to go. Out of Amazon, pullbacks until proven otherwise. The trend would need to change to down before I would aggressively trade it short. So those are some of the levels for you. Here's GOOGL. Google's a little bit more lackluster. It's not as strong as some of the other tech. And the reason I say that is just because, yeah, we got this break back over the 169, but remember that this is just a balance range and we've been stuck in the midpoint here at 175. So I've got some updated levels for you on the hourly. We had something here before, we had something here before. So some updated levels just to sort of carry forward on the chart as it is marching in the upward direction. The next step is show me acceptance over 175 and maybe we continue this rotation to the top end of the range, but it has to be a very clear risk reward opportunity to get the job done like this. If it's just some sort of like deep pullback and then possibly a break here, like if the risk has to be this large for this upside move, now we're dealing with like 1.5, maybe 2-to-1 risk reward ratio. That's not really attractive enough for me to want to enter this in the midpoint of that daily balance range that we were just describing. So yes, the trend is up. It looks like we have resolved 169, that daily inverted head and shoulders neckline to the upside here finally. But in my view, it's got to be an obvious trade setup to get us back to this equal high back here. The risk in the midpoint doesn't seem quite so worth it to me as of right now. Next up, the metaverse continuing to breach new all-time highs. Strong close on Friday up and over the 2-day balance highs, even the third high from the, what would that have been, Tuesday session, if you will, at 617. Chart speaks for itself. A lot of these have today in the episode. So what do we see here? Obviously, Brigade bolts over 617, keep the party going. If it's under 617 with a lower high, sure, maybe it's some sort of left head, right shoulder. I would be skeptical. Again, think about the risk-reward range that's even here. If you come in like this and do something like this, you get your equal low breakdown. Are you shorting this into 599? Good luck. I mean, I would not want to be short into 599. As a matter of fact, I would want to be long off of 599 for a daily Brigade bolt off of the previous all-time high, the top end of the balance range, right? So metaverse really speaks for itself there. I want to be more so long this than anything, more so long than short. And I believe also, didn't they just release Llama 3, like 3.3 or something like that, a new update to their AI model? So watching out for that. Tesla, bulls on parade. Strong breakout on Thursday, playing catch up with the broad market, noting that it did have its laggard ascending triangle. The broad market had broken out earlier on in the week. Tesla was the laggard, and boom, it followed through to the upside. Looks good. As of right now, strong continuation into the wackiest end-of-day move I think I've ever seen on a name. A lot of people actually who were trying to go out the weekend long Tesla anyways just got paid into the close. So it is what it is. I mean, generally speaking, consolidation over 382 gets continuation to the upside. Pullbacks hold over 374 and continue to the upside. At this point, I don't really see a reason why Tesla would not at least attempt some sort of all-time high. I mean, you've got all of these things going for it. The FSD news that came out the other day, obviously everything that Elon Musk is doing, if you want to call it a proxy for, of course, SpaceX or whatever other ventures he's got going on, the all-time high is just a hop, skip, and a jump away. We just broke right over this previous pivot right from back here. Huge, long-standing base. I wouldn't call it like the cleanest rounded bottom you've ever seen, but I mean, it's no doubt is breaking out of a base, right? So what's the next logical target on the higher time frame? It's all-time highs. So Tesla higher over the span of the next couple of sessions probably makes the most sense to me. Let's drop this side back down to an hourly. Let's get granular. We already did get granular. So we're all set, right? This daily higher low would also be very interesting over 350, 850. Next up, JP Morgan, how are we doing over here? Consolidation inside the box again. So look above and fail. We had talked about some, not pressures or strains, but pullback in the XLF. I would say if JP Morgan can get back over 248, rock and roll, S&P 500, it's bulls on parade. If you set the lower high, though, and move deeper into the midpoint of the range, I would have to be more neutral here and at least put the XLF a little bit of a back seat here for the broad market, right? Remember that this is the second heaviest weight stock inside of the second heaviest weight sector. Excuse me. So watching this very closely, and I think it all still just boils down to 248. That is your line in the sand. Netflix, mind of its own, it continues breaking to new all-time highs into the end of the week. It's rock and roll here. There's really not much to say other than pullback longs continue to be the name of the game. How many times, if anybody tallies the exact number of times I have said that in the video and leaves it down below in the comments section, I will be impressed. I don't know what I'll do for you yet, but I will be very impressed. Let's get into a couple of trade ideas. The first one, it's actually 1.5, is on SQ. On X, we had posted that there were 83 inside bar setups to scan through over the weekend, and these two really make the cut, in my opinion. So SQ, inside hammer on the Friday session, 3 equal highs over 99.20, targets what? 107. Brigade bolt up and over, gets sort of moving in the upward direction. Here it is on the hourly time frame chart. You can see that the stronger sellers here into the close of day on Thursday really did not see any follow through, right? If you just draw this level across from here, and then the breakdown on Thursday, notice that on Friday you opened above, tested below, and then closed where? Strong near the highs. So that's that lower wick we were just seeing on the daily bar there. To me, looks absolutely more bullish in the 3-day balance than it does bearish. We all know, and I've been talking about this on X a whole bunch, that SQ is somewhat of a proxy for a Bitcoin play. They own quite a bit. Jack, that smart old Jack, has a bunch of Bitcoin on, or in, I don't know if they're technically in the balance sheet or just they own a bunch of Bitcoin, but regardless, SQ, sleeper Bitcoin proxy there, which is, in my opinion, a little bit, I don't know if I'd say safer, but different, let's use that term, than MSTR MicroStrategy. In a similar vein, payment processors, PYPL. Let's take a look. Not necessarily a Bitcoin proxy over here, but look at the chart structure, very, very clean. Inside bars back to back on the Thursday and Friday session, holding lower wicks over previous resistance in the breakout level at 88, looking for follow through in the upward direction into 93.50. Looks good into 93.50 here out of PYPL. Looking for upside on that. Not interested if we see price acceptance under 88. Next up, we have V. Speaking of payment processors, it just continues. But do we want to be long or short on this chart? Hopefully you're looking at this and saying, hey, Matt, this looks more to me like a look above and fail. You are absolutely right. Upper wick on Friday starts to suggest that if we continue to reject 312, any consolidation here has 3 equal lows. Improper end of the auction should move into 305, the bottom end of the balance range from over here. Here it is on the hourly time frame chart, just so you can see how precise these lows are. 1, 2, and 3 from the open of that Friday session. The idea is that we remain weak underneath 312, and you probably want to short this if the S&P 500 looks weak early in the week. Not to say weak too many times, for some sort of pullback. If the broad market is pulling back, this is when I would want to use V as a possible short trade underneath 308.75. That is Visa in a nutshell. Once again, your target 305 on the daily. Let's come on into the next one, TSM Semiconductors. Charts back on the bull side. Reason being is that you have all of these equal highs, and look at that Friday session. Friday does something that the broad market did not do, right? Which to me is more of a bullish indication. It sweeps the Thursday low. It technically stops one time frame, and you have lows, higher lows. Every single candle, right, produces a higher low. Well, that stops on Friday. We sweep the Thursday low, and then what happens? Do sellers accelerate underneath? Absolutely not. Do they reject this resistance? No. We have a hammer candle closing back in the midpoint of that Thursday range. If we can consolidate in here and Brigade bolt up and over 205.25, I think it's a pretty straight shot into this level back here. This, I don't know, is that the all-time high? Let me not misspeak to you guys. Let's do something that looks like this. I believe it is. But I want to make sure that I'm not misspeaking, speaking out of turn. Yes, all-time high. Okay, so all set there on TSM. Looking for, if I just go back to the hourly, consolidation, Brigade bolt over 205.25, 211.25 is that target. Needs to hold 201.25. Next up, we've got ourselves RDDT, Reddit. Let's go to Reddit on a daily time frame chart. Not a monthly, but rather a daily. Here we go. And the idea here is that you opened inside of Thursday's range, you looked under Thursday's low, and where did you close? Over the previous pivot high, which was the all-time high, over 157.25. Strong IPO movers have continued to rally in the context of the market currently. So the next step is any higher low consolidation over 157.25 looks for continuation in the upward direction. Check it out on the hourly time frame chart. Pretty textbook cup and handle breakout beginning here to end the week on Friday. So Reddit looking for longs as long as it's over 157.25. Let's go back to the daily time frame chart and finish today's episode with none other than a retailer. TGT Target is next up on the chopping block, final in the lineup. What do we see? We've got ourselves a flat top with an earnings gap overhead to close. And the reason I wanted to bring this up is because if you look at Walmart, mean, Walmart is just up, up, up and away, and I'm pleased to own Walmart in the long-term account. Not, I'll be completely transparent here as well. I do also own some Target, more Walmart than Target, thankfully. But if we go back to TGT, I think that there's the possibility of a catch-up trade. I think that this got demolished on earnings, and I think that as long as Walmart and retailers are continuing to do well into the holiday season, I think there's a catch-up trade here. Even if it doesn't close the gap all the way, if there's a Brigade bolt that's executable from like 132 to 137, 140, something that's the midpoint of the gap, I think there's a strong opportunity here for some sort of long trade, especially if the broad market, the broad market wants to continue in the upward direction. That's all I've got for you in today's episode of the Weekly Watch List. We got the job done after missing the Wednesday update video. I'm pleased to be back at the home office, at the desk, and ready to rock for all of the episodes of the pre-market prep coming out this week. We will be live for that every single day this week at 8 o'clock Eastern Time, checking in on the markets, getting you prepared for the day, and hopefully ready to absolutely, what would you say, crush it? Nah, that seems too cliche. Have yourself a fancy trading day. Have yourself a green trading day. Now I'm just going off the rails into the week. Anyways, we'll see you here back on the channel through the week for the pre-market preps. We'll do the midweek market update on Wednesday. If you enjoyed the episode today or learned anything new, let me know down below in the comments section. I wish you all a green trading week, and I will see you in the next one.